Welcome. You're on the Fringe show. I'm your host, Tatiana Zalan, and I go live every Friday at 2 p.m. Dubai time. The Fringe helps you to navigate the rapidly changing world and increase the odds of your success. Here we discuss technology, startups, entrepreneurs, and mental models of successful people so that you too can take advantage of the opportunities in the new digital world. Today, we're going to talk about the crypto market and how the crypto market is different from any other market. In this episode, we will discuss things like volatility, crypto returns, liquidity, regulation, and other crypto market characteristics. I think that this show will particularly be suited for those of you who may be new to the crypto market and you want maybe to understand it a little bit better and gain an overall picture of the returns that you can get from this market, but also the risks. And of course, I'm only scratching the surface here because it's such a huge topic. We could discuss so many things. Let me remind you, it's a live show, so please allow Facebook to identify you. And before we even go any further, a disclaimer as usual. I'm not your financial advisor. I don't have a financial background. What I'm doing here is I'm sharing my passions and interests, and it's for information and educational purposes only. At over $2 trillion in dollars of market capitalization, this emerging 24/7 crypto asset market empowers ordinary citizens just like you and me with an internet connection to participate in wealth creation alongside with trillion-dollar institutions. The crypto market is open to mostly all people, unless your government prohibits use and trading and you holding cryptocurrencies. But in most countries around the world, it's regulated, but it's more or less open to all. But it's also a very unusual market, and that's exactly the topic of today's show. Let's first compare some very quickly. It's a very brief overview, helicopter view of how cryptocurrency markets differ from traditional investment options. So you can invest in stocks. Stocks have a very long history. It makes it easier for investors to predict the future. Stocks face, of course, several risks, including business, financial risk, market volatility, government regulations, and so on. However, cryptocurrencies, on the other hand, are decentralized. So for some cryptocurrencies like Bitcoin, there is no kind of government that can actually control them, although they can control the behavior of users. Bonds are a next asset class, and that's the major risk with bonds. If that the company of government goes bankrupt, then the investor will stop receiving interest payments and the principal amount. And the last time I looked at the US 10-year bond, government bond, the rate was 1.4%. If you compare that with the internet bond, and perhaps the best proxy is Ethereum on Ethereum 2.0, that's the returns there at the moment are 5 to 6%. Then, of course, we have Forex, and the economic conditions of the countries differ a lot. And so investors can expect positive returns if you only when the economy of that currency is in a good shape. And it makes it, I think, probably somewhat riskier than cryptocurrency. You can also compare cryptocurrencies with precious metals like gold and silver. The risks involved with investing in precious metals include their portability, their import taxes, and last but not least, their security. How do you keep these gold bullion secure? And some countries will not even allow you to do so. You can't keep gold bullions. You need to invest them otherwise. Crypto, on the other hand, is digital, and it makes it relatively easy for everyone to move things around. You can also compare crypto assets with fixed deposits, and fixed deposits are a really good vehicle if you have a long-term investment plan and you're prepared to wait till maturity. And there is an equivalent of that in crypto as well. It's staking, and staking usually gives you pretty good returns, and you do it for a period of time. Most of the returns are in the double digits, so they are they're quite attractive. And finally, you can compare crypto with art and collectibles. In traditional art, unfortunately, the returns have been very poor. They're in no way matched to traditional equities, traditional stocks. We also see a new asset class in crypto emerging, and that's crypto art. We're yet to see how that is going to play out because there is no active secondary market for crypto artists yet, but it's probably going to emerge. It's a very new market. Now let's discuss returns from crypto assets. And I mostly be focusing on two assets, Bitcoin and Ethereum. And that's because there's a lot of research and a lot of attention that's gone to these two assets in particular, because they're quite prominent, they're dominant, and Bitcoin has been around for quite some time. So we can have a pretty good data series. Other cryptocurrencies, altcoins, are quite new, so we don't have much data about them. And it's true to say that Bitcoin returns have been more volatile than other financial instruments. And not only that, but what we also note is a very high degree of volatility persistence. All of these assets are also have significant exposure to tail risk, what we call tail risk. And tail risk is just a chance of a loss occurring due to a rare event. Tail risks are measured by distributions, 3 standard deviations from the mean. So if a normal bell curve looks something like that, big tail risk will have very, very long tails. And we're particularly worried about the left tails, of course. And while the asset like Bitcoin is still in its infancy compared with commodities like gold, compared to stocks, it has delivered extraordinary returns. There is a gentleman called Charlie Bilello, and what he's done, and I'm just holding in front of me the calculations that he's come up with. Charlie Bilello is the CEO, co-founder of a crypto advisory firm, and he compiled the performance of the top asset classes using publicly available data. So he compares Bitcoin to many other asset classes, including gold, including large caps, small caps, and bonds as well, and so on. So it's a data set for 10 years, starting from 2011 to now 2021. The cutoff period here is March 2021, so it's maybe slightly off right now, but I think it's pretty much accurate. What is very clear is that Bitcoin, over the 10 years, over a decade, Bitcoin has outperformed all other asset classes by at least a factor of 10. Bitcoin has produced an average annual return of 230%. That's more than 10 times higher than the next second-ranked asset class. The next second-ranked asset class, US NASDAQ 100, these are big tech stocks, right? And they tend to perform really well. The annualized return there is 20%. If you look at the next number 3 in this position, it's US large caps, large companies with market capitalizations over $10 billion, and their annual returns are 14.9%, not 14% to be exact. And the next in this ranking are US small caps, the only asset class that had double-digit returns over this time period for the past 10 years, and their returns are over 12%, 12.9% to be precise. If you look at gold, gold is very interesting. Gold made really paltry annualized return of 1.5 1.5% since 2011, and 5 out of the past 11 years producing a loss for that asset class. And according to gold price, the precious metal has fallen almost 8.5% since the beginning of 2021. What's also remarkable is that since 2011, Bitcoin has got annualized or cumulative annualized, not annualized, but cumulative returns. And they have been whopping 20 million%. No, it's not a slip of the tongue, not 20,000, it's 20 million%. 2013 was Bitcoin's best performing year, and their returns there were 5,000 and 5,507%. So have there been any losses? Yeah, there were two losses, annualized losses, Bitcoin falling by 58%, and that's in 2014, and in 2018 it fell by 73%. So since the start of 2021, Bitcoin's price has been at all-time high of over $60,000 per Bitcoin. Now it's a lot less than that, of course, because the market is so volatile, which is exactly what I'm talking about in this show. Let's look at the Ethereum prices and returns. And that's something from Statista, historical summary from 2017 to 2020. And Ethereum, of course, is a much younger cryptocurrency. Their best year being 2017 with returns of 9,159%. And their mean annual return over these years that Statista tracked was 2,383%. And despite pulling back from its all-time high early this year, Ethereum still has a shot at $8,000 to maybe $10,000 by the end of the year. And it's not just me saying that. Multiple analysts have done their calculations, and this is what they're saying. They're going for a number of upgrades, and the upgrade is likely to catapult Ethereum and the network itself when it is completed. Those proposals will initiate what we call the burn, when a lot of coins will be burnt, and that will make Ethereum a deflationary asset. Very much like Bitcoin at the moment. It's not like Bitcoin, but it will be. We mentioned volatility so many times, so let's look at volatility first, what we mean by volatility and how we can think about volatility in traditional markets versus crypto markets. Volatility is just the degree of a variation of an asset's trading prices relative to the mean price over a certain period of time. And the more volatile the price of an asset is, then the greater the frequency and the number of the price changes. Many investors, many traders do track an asset's volatility. There is, and we can differentiate between healthy volatility and unhealthy volatility, extreme volatility. Healthy volatility serves many purposes in the market, but it creates opportunities for profits, and this is probably its major purpose of volatility. Traders love volatility because this is when they make their money. So stock price changes enable traders to buy low, sell high, or probably short a stock when they expect a decrease in the price. It can also be quite extreme, with sudden price movements in either direction. Extreme volatility often has a negative connotation because people think of market chaos, of uncertainty and loss. And this is, of course, true. One of the largest extreme volatility events was in 2008, when traders, spooked by possibility of collapse of the entire global financial system, caused the Dow index, Dow Jones Industrial Average, to collapse more than 700 points. And that's happened in one day. The good news is that all these cases of extreme volatility are also extremely rare. To measure volatility in traditional markets, we've developed an index. It's called the Wall Street's Fear Gauge Index. It defines the healthy volatility of anything between 12, which is considered low, to 20, which is considered high. If the stock market's volatility is calculated by movements of its index falls above this range, then it's said to be a case of extreme volatility. And that volatility index or fear index touched a very high point in October 2008. It was almost 90 at the height of the financial crisis. And then a year later, or less than a year later, actually, it fell down to around 20. And that typically three factors that usually contribute to volatility in traditional markets. One is the rapid news cycle. So news does have an impact on speculators. They incite speculators to move in and out of trades more quickly. The increased entry of institutional investors is another factor. They individually or collectively can move the market, and the emergence of derivative markets, which indirectly influences traditional spot markets. Plus, on top of that, we know that the global intertwining of financial markets, where events in one part of the world will contribute to the events in the other part of the world, they also contribute collectively to the moves in this volatility index. Now, what about volatility in crypto markets? Crypto markets are an entirely different league altogether. I'm not aware of really good indices to measure crypto price volatility, but we've all seen historical charts with skyrocketing peaks and kind of depressive lows. They occur at a much quicker and more extreme pace in crypto markets compared to asset prices in other markets. For example, in 2016, on the positive side, the price of Bitcoin went by 125%. And in 2017, the price rose again, and that time by more than 2,000%. And many of the reasons for price volatility in mainstream markets may hold true also for cryptocurrency markets as well. It's certainly news development and speculation. They are certainly responsible for fueling all these price surges in crypto, but their effect is exaggerated in crypto markets, as these markets have less liquidity than traditional markets. I'll talk about the liquidity in a second. So this heightened volatility plus a lack of liquidity can create a really dangerous combination, because each of those feed off each other. And other than Bitcoin, there are no really established and widely adopted derivatives markets as yet in crypto markets. Whether volatility will eventually track the patterns of volatility in traditional markets, we don't know. We're yet to see. But as an asset class, this asset class continues to grow, to mature as more and more institutional investors come in. Then probably the volatility and therefore risk will decrease in those markets. And since we're on the topic of a new market, there are really very interesting characteristics of this market as such. There is an interesting academic but also industry framework which is called Rogers Adoption Curve. And what Rogers has said that the way markets or people in the market adopt a new technology differs depending on their preferences. And the early market is something like 16% of the total market, and then we get to the early majority, and this early majority are where actually adoption occurs. So this early market, we're not there yet if we're looking at Bitcoin, at cryptocurrency adoption, generally speaking, because in the world, anything between only 1% to 2%, these are the figures that I know, only these percentages, very low percentages of people who hold crypto in their wallets. However, when we compare the adoption of crypto with the internet, well, what we'll find, and these are official statistics and data, that in 12 years, Bitcoin reached 135 million users, and it is projected to reach 1 billion users by 2023. Some people are saying, analysts are saying 2025, but everybody agrees that the Bitcoin will reach its 1 billion users, regardless of the date, as a milestone in half the time than the internet did. And that, I think, is a very, very interesting indicator in itself. DeFi has been a significant driver of adoption. DeFi is decentralized finance. It has grown to $80 billion industry in 2021. And many analysts predict that it will explode tenfold in the years to come, and particularly in 2022. Yes, it's because it's a still a new nascent market. It is less liquid. It moves more quickly. That allows for manipulation. In traditional markets, what we see that the buy and sell spreads are very low. In many cases, they are really zero. In crypto, bid and ask can be several dollars, which is, of course, creating huge opportunities for people who are arbitraging on different exchanges. It's relatively unregulated. Regulation does differ, and I'm going to talk about that too. People and retail investors buy on hype. They're not sophisticated investors. So 80% of all investing and trading, it's really psychological investing. And because it's a new market, everybody is speculating about the potential of this great technology. This is in no way different from what we've seen in the early internet, and particularly with the boom and bust around 2000, when we've seen lots of fortunes being made, but also lots of companies, lots of investors really being decimated in this market. But if you don't want to have these bubbles on booms and busts, you won't have innovation. And financial capital, financial speculation is absolutely necessary for innovation. Liquidity, or lack of thereof, or thin liquidity, is another characteristic of this market, of the crypto market. What is liquidity, firstly? Well, liquidity is a measure of the ability to either buy or sell a particular asset at the current market value, at the fair market value as well. For example, if you have Bitcoin and you want to turn it into US dollars, there needs to be enough demand on the other side in order for you to be able to make the sale at the current exchange rate, right? Is Bitcoin a liquid asset? Well, the liquidity of crypto assets does differ depending on the crypto asset, depending on the trading volumes. But of all the crypto assets, Bitcoin is, of course, very, very liquid. There are hundreds of different exchanges, and that contributes to price discrepancy. If all cryptocurrency had been centralized and then all traded from one single centralized exchange, then surely the market would have been more liquid, but that's not the case. There are many different centralized and decentralized exchanges when you can trade crypto. If you compare that to the liquidity of a stock, it's typically centralized on a single exchange. If you want to buy Apple, all exchanges of Apple stock are made on the NASDAQ exchange. With cryptocurrency, liquidity is split between all these various centralized and decentralized exchanges. Other highly liquid assets include stablecoins, like USDT, also Ripple, and that's very widely used by banks and financial institutions, which brings us to an interesting point of institutional investment. We haven't seen yet the scale of institutional investment we would like to see to ensure better liquidity and lower volatility in the market. Most people who are using cryptocurrency-related services worldwide are people like you and me. They're retail investors, they're retail clients, they're not institutional clients. But this is changing as well. There's just been an article in Forbes about saying institutional money is pouring into the crypto market and it's only going to grow. And they're giving the example of BlackRock. Well, BlackRock is the world's largest asset manager. They basically own half of the world's assets. And they've got $9.5 trillion of assets under management, and through their Strategic Income Opportunities Fund, they are investing a lot in crypto. The fund itself is over 40 billion. I mean, it's significant, but it's not huge yet. Another example they're giving here is Grayscale Bitcoin Trust, and that's over 20 billion at the moment. And interestingly enough, they're not just investing in Bitcoin or Ethereum, which are more stable and crypto assets, but also in altcoins like Filecoin and Basic Attention Token and Chainlink. So that's changing too. And finally, let me mention a little bit about regulation. Because regulation does affect the market. And news about regulation affects the market when and the two largest markets here are China and the US. China, because much of the hash power used to be, of Bitcoin's hash power used to be in China. And now the US market is interesting because there are lots of consumers there. It's on the buyer's kind of market. Lots of retail investors and lots of entrepreneurs working in this area as well. One of the biggest targets for regulators right now are stablecoins. Stablecoins are just cryptocurrencies that aim to maintain stable value to counteract this volatility that we've seen in other assets. And that's relative to a benchmark. This benchmark can be a commodity, a fiat currency like US dollar, or a basket of assets like real estate, for example. And anyone from the Fed to the SEC and numerous other global entities and three-letter organizations, as they call them, they're really very interested in regulating stablecoins. Stablecoins, according to the SEC, Securities and Exchange Commission, are a security. They're applying the so-called Howey test to stablecoins, which is from, believe it or not, 1946. We live in a digital age, and we're still using these archaic laws. And they define an investment as security. If a person invests his money in a common enterprise, is led to expect profits from this enterprise and solely from the efforts of the promoter or a third party. So there are 4 conditions to pass this Howey test. And according to the SEC, it's stable coins are derivatives and kind of derivative securities. That's how they look at them. There are other targets for regulation at the moment. There are several current cases like Kik, Telegram, Stun, and XRP, Ripple. They're allegedly securities, according to the SEC. Crypto exchanges are under regulatory scrutiny. Coinbase, centralized exchange; Uniswap, decentralized exchange. Coinbase was about to launch lending product called Coinbase Lend, and the SEC said that it will violate cryptocurrency laws, so the project was halted. There is also a very blatant attack on DeFi. There is a threat to bring it under the policy framework, but not proposing any regulatory framework as a substitute for that. Interestingly enough, Gavin Wood, co-founder of Ethereum and also project leader for Polkadot, came up with an interesting statement. According to him, the fact that regulators are attacking DeFi is not such a bad thing, because that will force all these projects to become decentralized. Because if they are decentralized and users own most of the stock, of the cryptocurrencies, if they participate in voting, decision making, and so on, then they are not relying on the third party; they're actually doing it. And he says that he thinks that as long as the regulators protect technologies and technologists, then and he probably thinks it's a good thing, it will force these crypto projects to get decentralized, because otherwise, sooner or later, this lack of decentralization will kind of show its ugly face at some point in time. Of course, all these projects are very easy targets because the exchanges are highly centralized. They can easily freeze user accounts if they need to. They can have full control of the collateral that's backing all these stable coins. That's one of the main reasons why crypto users now are on the frantic search for different types of stable coins, truly decentralized alternatives, in particular decentralized and algorithmic stable coin. An example of that is UST. And as a kind of consequence of that, that's probably nothing to do with volatility, but is just a consequence of this regulatory overreach, I think, is that a lot of smart money and smart entrepreneurs will move elsewhere from the US. They will find better places, and I'm currently in Dubai, and Dubai is shaping to be a crypto hub because the government here and the SEC, the equivalent of the SEC, which is the UAE Securities and Commodities Authority, together with the Dubai World Trade Center Authority, which is a free zone. They've signed an agreement saying that it's okay to trade, to offer, to issue crypto assets as long as they're regulated and related financial activities. So that's what I think will happen if regulators persist. So what are some of the key takeaways here for you? Yes, the crypto market is highly unusual. It's very volatile. It's somewhat illiquid. It's immature. There's still no institutional investors. But it's also it's highly risky. But the big but is that the ROI, the returns, are exceptionally high. We haven't seen them for any other asset class. It's an emerging, it's new market. It's still very early. Adoption is early, and that's probably good news for you. This is once in a lifetime opportunity to get into this market. Again, it's not financial advice. It's for information purposes only. But I do think that you're sitting on the fringe, you're probably losing out on this wonderful opportunity. Well, thank you for joining me today. I shall see you on the Fringe show next Friday at 2 p.m. Dubai time. And let me now, I have difficulties actually ending this podcast. Something happened, and let me try again. Now I can't end this podcast. Unfortunately, wanted to have some music, and that didn't work. I'll probably just need to shut down the computer if I can. See you later, and thank you for joining me. I have no idea what happened, but